Today we're going to talk about the New to Canada program. Let's say you are moving to Oakville and you want to buy a home. I'm going to share with you what a sample application could look like. So in Oakville, when I spoke to my realtor friend Ashton, he mentioned that probably you could buy a place in Oakville for $900,000. Applications are driven by the down payment, the income, the credit, and the property. Let's talk about down payment. In Canada, there are 3 mortgage default insurers, and I'm going to take you to each of their websites. They require 5% of the first 500 and then 10% of any amount over 500 to a maximum of $1 million, just under $1 million. So literally 999,999 is your maximum purchase price currently. Perhaps the government will change that. So for a $900,000 purchase, your minimum down payment would be $65,000. Then the lender will loan you the amount for the mortgage default insurance on top of what you need to buy the home. So in this case, it would be $33,000. So your total mortgage would be $868,400. How do you qualify for a mortgage of $868,400? You have to have the income. In this case, you would need $15,000 a month in income to make these ratios work. So the cost of carrying the home divided by the income has to be under 39. And if you have any other debt, that will be added as well. In this case, I didn't put any in, but if you did, this number has to be under 44. I'm going to take you to the 3 New to Canada programs because besides income, the other problem can be, oh, interesting. Credit. When you're first getting to Canada, you haven't built up your credit profile here. So we're going to talk about, here's Canada Guarantees program. You can go to Maple Leaf Advantage, New to Canada, and they will give you all the details to talk about how you can qualify for a purchase. And how they can, this is how they will determine your credit. So if they can get an international credit bureau, so TransUnion and Equifax are what we use in Canada, but they are an international, they're both international companies. So if you have the same bureau in your country of origin, that could be very helpful. Now, this loan to value is when you're doing the minimum down payment. They need to see the International Credit Bureau, or they need to see 12 months of rental payment history or utilities. So you can go through this and see, you can contact me. I can help you understand what they're saying here. But a big issue is establishing the credit. So, okay, now let me take you to the next one. This is the other mortgage default insurer in Canada. And they also have a New to Canada program. Here we go. And they'll explain the eligibility, having a valid work permit or permanent residency, and having a minimum of 3 months full-time employment. Those transferred under a corporate relocation program are exempt. So if you're working for a big multinational and you're being transferred, then that 3 months can be waived. And then you can get into more of the details here if you click on this. The other big mortgage default insurer in Canada is CMHC. Let's do CMHC New to Canada. And the programs are all very, very similar. And they have a category for permanent residents, non-permanent residents. So you can go through and get an idea. So it's a great overview. The mistakes that I've seen people make, and this is across the board, but let's talk about new Canadians. Often, you come here, you develop credit quickly, you've got a great job, a lot of people working in IT, and then you go and get a big brand new car. And now you have an $800 a month car payment, which is no problem for you, but it's going to really hurt you when you go to buy a home because let's look at an example. So in this example, let's add an $800 a month car payment. Okay, so that's income. Where's liabilities? Here we go. Oh, that's okay. So that one isn't in the ratio. So I'm just going to add one. Okay. In this case, you could squeak through if you have no other debt whatsoever, because this number has to be under 44. So let's say you get a $900 car payment, which isn't hard to do. They love selling cars. Now you're over 44, and now you would have to reduce the amount that you are going to purchase. So let's see how much you would have to reduce the amount you were going to purchase. Let's say we'll make it 880 now. Keep the down payment the same just to keep it simple. Okay, so maybe maybe we can get up to 890. Okay, so that $100 a month car extra going from 800 to 900 reduces your purchasing power by $10,000. So you really got to be careful what debt you take on. Also, when you get here, if you have kids, make sure you apply for the Canada Child Benefit. For some reason, some people don't know that. And I had a client who was able to get it and also get back paid just because he just didn't know about it. So that can help. Even a couple hundred a month can make a difference in income. So let me just add in some income here and show you. Let's see, $200 a month. You see how it changes the ratios, and it's not hard to get $200 a month for your kids, even if you have a pretty good income. And the other mistake is if one is the big income earner and one isn't, even the non-big income earner should still develop credit. They often don't, and they should, even if they're home with the kids. They need to start developing their credit profile. So secured credit cards, if you can't, I know at one time, I used to work for TD. TD had $1,000 a month for new or $1,000 credit limit for new Canadians. You can just walk in and get it. You really got to start building your credit quickly. But also, like maybe, the cell phones, actually I think in this fact sheet with CMHC, they give you a lot of detail of the different, okay, this here, let me just expand that. Alternative sources of credit can include rent, room or board, financial obligations, or documented regular savings preceding 12 months. That's pretty interesting. Confirmation of rent payments not available. They can provide 3 other types of obligations over the last 12 months, including but not limited to utilities, cable, childcare expenses, insurance premiums, or documented regular savings. So just make sure that whatever obligations or accounts that you're setting up, that you do it for both of you, not just the one, because the other one needs to develop credit as well, because if they're getting the Canada Child Benefit, because usually the lower income spouse gets the Canada Child Benefit. So even that $200 a month can be used if they've established credit. So make sure you're both establishing credit. The other thing is get your money into Canada. I've had clients trying to bring money from Pakistan, and it's taken them forever. I don't know what's going on with that, if it's just their specific thing or if it's just the complex way things work. Mexico is another one where people have had a hard time getting money. Brazil seems to be pretty quick. UK have had no problems. So I don't know. I haven't had to move money internationally, so I don't know, but I would definitely make good connections with your institutions in your home origin and connections in Canada, and figure out how you can get the money transferred quickly. So I hope that's helpful. The way I work is if you do an application with me and you send me all the documents I asked for, I will work really hard for you to try to get the best pre-approval in place and get you ready to be able to purchase with confidence. Thanks for joining.